Welcome to the Deep Dive. We're here to turn those dense quarterly financial reports into clear, actionable insights for you.
Absolutely. Today, our focus is Citigroup, ticker C, and their Q3 2025 earnings. We've worked through their official press release and a detailed earnings analysis report.
Yeah, and our mission today goes beyond just the headlines. You probably saw the news, decisive beat on all fronts, big claims.
Big claims indeed. So we're using our five-part framework to really assess, is this quarter a real sign of strategic progress for Citi?
Exactly. They reported really impressive earnings growth EPS up over 23%. That's on strong revenue growth too, about 9.3%.
But, for anyone following Citigroup's turnaround story, the metric that really matters is return on tangible common equity, ROTCE.
Right, that's the big one.
We'll be digging into how close they actually got this quarter to that crucial 10% threshold. Hitting that could be key to changing how the market values them.
Okay, let's dive right in. We're structuring this around 5 key slides, 5 areas of performance.
Let's start. Now for slide 1, the at-a-glance scorecard.
And right off the bat, this was undeniably a win on the top line. Total revenues hit $22.09 billion.
Which was, what, almost $1 billion over the Wall Street consensus? They were expecting something around $21.1 billion.
Exactly. $1 billion. That kind of beat, especially for a massive bank like Citi, is pretty unusual. You don't see that every quarter.
No, you really don't. And the market definitely noticed. Shares ticked up, I think it was 1.2% in pre-market trading right after the announcement.
Okay, but the earnings per share, the EPS figures, that's where you need to look a little closer, right?
Yeah, the reported diluted EPS was $1.86. And this is but that number includes a significant one-time item, an accounting charge.
Right, the impairment charge. So if you adjust for that, if you pull that out to see the core operational performance.
The adjusted diluted EPS jumps way up to $2.24. And that number blew past even the high end of analyst estimates. It shows real execution, not just growth.
And looking year over year really highlights the acceleration. Total revenue up 9.3%. Okay, fine. Net income to common shareholders up 17.5%. Nice jump.
But then diluted EPS soaring 23.2%.
So here's the key question then. Why did the earnings per share grow more than twice as fast as revenue? How did they manage that kind of profit acceleration?
Well, it boils down to a mix of, let's say, operational smarts and some financial mechanics. Two main drivers.
Okay.
First one is positive operating leverage. This is what every company strives for, right? Your revenue grows faster than your costs.
And the numbers back that up.
They do. Revenue up 9%, like you said. But if you exclude that goodwill charge we mentioned, which wasn't operational, their adjusted operating expenses only went up about 3%.
Ah, okay. So that gap between revenue growth and cost growth widens. More revenue falls to the bottom line.
Exactly. That's efficiency scaling up. The second driver is more about capital management, share buybacks.
They've been pretty active there, haven't they?
Very. Returned $12 billion so far this year, with a big chunk of buybacks just in Q3. So the number of actual shares outstanding dropped by 5.4% compared to last year.
So fewer shares dividing up the same, or actually bigger, profit pool mathematically boosts the earnings per share?
Precisely. It's that combination. Solid operating leverage plus the share count reduction. That's your 23.2% EPS surge.
Got it. Okay, let's move on.
Moving to slide 2. The engine of profitability.
All right, so we've seen the operational efficiency gain. Now, how well are they actually using their capital? We usually start with the efficiency ratio here.
Right. Non-interest operating expenses divided by total revenue. Lower is better, obviously. The reported JAP number was 64.7%.
Which is, a slight improvement year over year, but not dramatic.
But again, we have that noise in the numbers. That $726 million pre-tax goodwill impairment charge. It relates to the Banamex sale.
And it's important to stress this isn't about Q3 operations, right? It's an accounting thing, a non-cash adjustment related to an old divestiture.
Exactly. So if you strip that out to see the underlying trend in cost control, the adjusted efficiency ratio looks much better. It's down around 61.4%.
Now that shows more significant progress on managing costs relative to revenue.
And that cost discipline flows directly into the metric investors watch most closely. Return on tangible common equity, ROTCE.
We focus on tangible common equity because it strips out things like goodwill, focusing on the core capital generating profits, right?
Precisely. It's the key measure of profitability on core capital. The reported ROTCE was 8.0%. That's up a full percentage point from 7.0% last year. Decent improvement.
But the critical question again, what does that ROTCE look like adjusted for the goodwill charge?
Okay, here's the number everyone was watching for. Excluding that charge, Citigroup's adjusted ROTCE hit 9.7%.
9.7%. That feels significant.
It's hugely significant. It's the core of the turnaround argument.
Let me just push back slightly, though. We're relying heavily on this adjusted figure. If these one-off charges keep happening, quarter after quarter, how much faith can investors really put in that 9.7% versus the official GAAP number?
That's a very fair point. Consistency is key. But generally, the market is willing to look through clearly defined non-operational items, especially if the underlying trajectory is positive. And here, it clearly is.
Okay.
Remember, Citigroup's stock has been stuck trading below its tangible book value for ages. Crossing that 10% ROTCE threshold consistently is widely seen as the trigger needed for the market to re-rate the stock, to value it above tangible book.
So hitting 9.7% adjusted means they're basically knocking on the door of that re-rating.
Exactly. They are right there on the cusp. It suggests the strategy might actually be working towards creating shareholder value in a way the market recognizes.
All right, makes sense. Let's look at where the growth actually came from.
Now for slide 3, the engine room business segment performance.
And the CEO, Jane Fraser, made a bold claim here. She said, every business had record third-quarter revenue, improved returns, and positive operating leverage. Every single one.
It's a strong statement, but looking at the segment details, it largely holds up. The strength was surprisingly broad-based.
Okay, let's break it down. Starting with services often called their crown jewel, right? Very stable, high returns.
That's the one. Revenue up almost 7% to $5.4 billion. Solid growth. But the profitability, wow,
Yeah.
generated $1.8 billion in net income.
And the ROTCE for just that segment.
An incredible 28.9%.
28.9%. That's huge.
It really is, driven by things like higher deposit balances, good spreads in treasury and trade solutions, and a big jump 13% in assets under custody and administration. That division is a powerhouse.
Okay, what about markets? That's their biggest segment by revenue, isn't it?
Yes, it is. And it had a fantastic quarter. Revenue hit $5.6 billion, up over 15% year over year. They really played the market volatility well.
How did that break down?
Fixed income was strong, up 12%, thanks to rates and currencies activity. But equities markets were on fire, up 24%.
24%? What drove that?
A lot of client activity, particularly in derivatives and cash equities. Plus, they mentioned record prime balances, which were up something like 44%. The bottom line for markets, net income surged almost 46%.
Impressive. So services stable and strong, markets capitalizing on the environment. What about banking? That's been a tougher area.
It has been, but this quarter showed a major resurgence. Revenue shot up 33.5% to $2.1 billion. And get this, net income was up 168%.
Whoa. Okay, 168%. That sounds almost too good. Is that sustainable or just catching a wave in capital markets activity?
Well, capital markets are cyclical, no doubt about it.
Okay.
But the details suggest real momentum. Investment banking fees were up 23% overall.
Across the board.
Pretty much.
Yeah.
Debt capital markets up 19%. Equity capital markets really strong, up 35%. And even advisory fees were up 8%. So yes, it's cyclical, but that broad strength suggests they're definitely capturing market share right now.
Okay, good context. And quickly, the consumer side.
Also solid. Wealth management revenue grew 8.5%. They highlighted record net new investment assets coming in $18.6 billion for the quarter. Client assets up 14%.
And U.S. personal banking.
USPB revenue up 7.4%, led by branded cards up 8%, and a really strong showing in retail banking, which jumped 30%.
So when you pull it all together,
It really does look like Fraser's claim holds water. Strength across services, markets capitalizing, banking rebounding strongly, and solid consumer performance. It shows their interconnected model actually working, capturing different tailwinds simultaneously.
okay, that paints a pretty positive picture operationally. Let's talk financial strength.
Next is slide 4, financial strength and shareholder rewards.
Foundational to everything else is the capital position, right?
Absolutely. And the main metric we look at is the Common Equity Tier 1 capital ratio, CET1. It's the measure of the highest quality capital buffer.
And how did Citi look there?
Very strong. Preliminary CET1 ratio came in at 13.2%,
13.2. That's well above the regulatory minimums, isn't it?
comfortably above. And that gives management a lot of flexibility, a lot of optionality in how they manage their capital.
And it seems like they used that flexibility to reward shareholders pretty aggressively this quarter.
They certainly did. In Q3 alone, Citigroup returned about $6.1 billion to common shareholders.
6.1 billion. How much of that was buybacks versus dividends?
The bulk was buybacks, a hefty $5.0 billion on top of the regular dividends.
Yeah.
That's a significant amount of capital being sent back.
Now, I did see a number in the release, a payout ratio of 176%. That sounds alarmingly high, paying out more than you earned.
Ah, yes. That number looks weird, but it's purely an accounting distortion. It goes back to that non-cash goodwill charge we discussed.
Because the charge artificially lowered the GAAP net income denominator.
Exactly. GAAP net income was temporarily suppressed, making the ratio mathematically explode. It's not a reflection of cash flow issues or anything like that. The real signal is the dollar amount, $6.1 billion.
So the takeaway isn't alarm, but rather management confidence.
Absolutely. Returning that much capital, especially via buybacks, signals that management strongly believes the stock is undervalued and they're confident about future earnings. They're backing up their strategy with serious cash deployment.
Okay, that makes sense. Let's bring it all together.
Finally, we wrap up with slide 5, the road ahead management's outlook and key takeaways.
Management seems to be framing these results as clear proof their strategy is working.
Yeah, the CEO commentary reinforced that. Phrases like relentless execution of our strategy and talking about the positive effects of simplifying the bank and the transformation efforts.
So if we had to boil this down for someone watching, what are the main conclusions? Maybe 4 key takeaways.
Okay, 4 key things. First, this was definitely a high-quality earnings beat, driven by that broad revenue growth across segments, and crucially, that positive operating leverage kicking in, cost-controlled.
A second.
Second, the core profitability engine is revving up. That adjusted ROTCE hitting 9.7% is the big catalyst here. It shows they're right on the edge of that critical double-digit return level.
Third, the business model showed its strength this quarter. You had the steady high returns from services providing a base.
Combined with really impressive upside from markets and the resurgent banking division catching the cycle perfectly, balance and upside.
And the final takeaway.
Capital strength enabling major shareholder returns. That solid 13.2% CET1 ratio isn't just sitting there, it's actively funding that massive $6.1 billion return in Q3, signaling deep management confidence.
So looking at Q3, it really does feel like a potential breakout quarter. We're seeing tangible proof points now that the strategic overhaul is translating into better operational efficiency and that faster EPS growth.
And that leads us to the provocative thought, the thing to really watch going forward. It all comes back to that 9.7% adjusted ROTCE.
Right.
If, and still an if, but if Citigroup can keep that cost discipline tight and consistently push that adjusted ROTCE figure over 10% in the next few quarters,
then the market narrative could really shift.
Fundamentally, the persistent valuation discount that's dogged Citigroup stocks for years could start to disappear. Crossing 10% consistently could force the market to see them as a reliable value creator again, potentially closing that gap to tangible book value. That 9.7%, pushing towards 10%, is the number to track.
A critical metric to keep an eye on. Okay, before we wrap up, the necessary reminders.
Indeed. Please remember, this discussion is for informational purposes only. It is not financial advice.
Always conduct your own thorough research before making any investment decisions. And also note, this analysis was generated by AI based on the source documents provided.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.